You are now tuned in to Upskill Professionals, helping you forge a path upward. Because once you stop forecasting your future performance based on your past failures, you'll soon begin to realize just how within reach new heights truly are. Once again, my name is Chris. I am your career coach here at Upskill Professionals, and today I have two main questions for you. The first question is, do you have enough money in your retirement account to live a life in retirement that is stress free? And the second question is, if not, are you on track? And if the answer to either one of those questions is no or I don't know, it's time to hit the panic button. Now, you may be thinking to yourself, look, Chris, I still have 20 to 30 years to continue building my nest egg. I already have some money saved in a 401k account, and there's always Social Security to help me out, right? Well, on that last point, I implore you to take a look at the SSA.gov website. But if you are the average American today, I have some harrowing statistics for you. And the first comes from usafacts.gov, and it estimates that as of 2022, only 46% of Americans actually had a retirement savings account. Now, let's just give the benefit of the doubt and say if you're investing for retirement in something like a high yield savings account as opposed to a retirement savings account, you're missing out on the tax advantages that those retirement accounts offer. And that means that you are essentially handing money over to Uncle Sam unnecessarily, and we don't want to do that. Now, the second statistic, which I found particularly interesting, comes from a variety of different sources. I'll make sure to put some references on the screen, but it estimates that the typical American heads into retirement with a median nest egg of approximately $200,000 to $300,000. Now, that may seem like a lot of money, but I want to give you some additional context to put it into perspective. Now, obviously, you can begin withdrawing from your 401k or Roth IRA as early as 59 and a half years old, but let's just say you decide to take the more traditional route and retire at the age of 65. Now, the average life expectancy for men is around 73 years old. The average life expectancy for women is around 79 years old. Let's just split it down the middle and say that the average life expectancy is 76. That means that you have approximately 11 years to live between the age of 65 and 76 to live off of $200,000 to $300,000. Now, whether you have all of that money invested and you're only living off the growth, or whether you're drawing down on the principal of that nest egg, that means that you're only living off of approximately $20,000 to $25,000 a year. And keep in mind, this is at a point in your life when your medical bills and your insurance rates are likely higher than ever. Now, I want you to just pause for a moment and think to yourself, is that the type of life that I imagined or envisioned for my retirement? And if that causes you some concern or some angst, I'm happy, because that means that you are now empowered with the knowledge and the perspective to put yourself on the right track for retirement. And as you embark on that journey, I have 5 key mistakes that you want to avoid. Now, the first mistake that you want to avoid is just parking money into your retirement account and not actually investing it. So, obviously, when you put money into your 401k or Roth IRA, you are getting the tax advantages, which is a good thing. But there's also this little gremlin called inflation that's nibbling away at your nest egg to the tune of 3.5% on average year over year. And the only way to really hedge against that inflation is to invest your money in an asset that's going to grow at a rate greater than 3.5% every year. And we'll talk about some of the options as we head into the second mistake that you want to avoid making as you save for retirement, and that is not managing your investment elections. Now, when I say investment elections, that simply means where you are investing your money. And obviously, you don't want to take a look at your investment elections every week or every month. You want to choose some fairly stable investments that you just want to manage or monitor the performance of over time. But when you enable investing within your 401k or Roth IRA, the default investment option that you typically get is a target date fund. As a matter of fact, an Investopedia article estimates that approximately 50% of all retirement account holders have all of their retirement funds invested in a target date fund. So now you may be asking, what is a target date fund? Well, that is essentially a mutual fund that reallocates your investments according to your age or target retirement date. And so the underlying principle here is that when you have more time to save for retirement, aka when you're younger, you want to be a little bit more risk tolerant and invest in things like individual stocks where you have more potential upside, but you're also incurring a little bit more risk, which should be fine in theory because you have more time to bounce back from any potential losses. However, as you approach your retirement target date and get older, you want to become more risk averse. And so you'll start divesting from things like individual stocks and reinvesting in CDs, T bills, and bonds where you're not really going to lose any money. There's low risk in those investments. You're not going to make a lot of money either. And so the beautiful thing about a target date fund is that you have that sort of risk management strategy built into the investment. Also, that means that it's a little bit more hands off in that sense. Now, the downside to a target date fund is that because the fund is actively managed, that cost is going to be passed on to you in the form of typically higher management fees or expense ratios for your investment, which can nibble away at your nest egg over time. So, what I've personally decided to do is divest from target date funds and instead put my retirement funds in an index fund which seeks to mirror the S&P 500. So the difference here is that index funds are not actively managed and they buy into the companies that most greatly represent the S&P 500, which on average returns 10% year over year. And so the call out here is not to just go put your money into an index fund instead. The call out here is to make sure that you are cognizant of what you're invested in, what your investment options are, what the schedule of fees associated with those investment options are, so that you can make an informed decision of where you want to put your money. And that may also mean getting a fiduciary or financial advisor who can coach you on some of the details. Now, the third mistake that you want to avoid when it comes to saving for retirement is not knowing the difference between a 401k and a Roth IRA. So I'll give you a quick overview. A 401k is a pre-tax account. This means that you get paid, and before you pay taxes, you put money into your 401k. And when that money is in the 401k, it has the opportunity to grow tax-free as you invest it. And then when you withdraw money from your 401k, you get taxed on those withdrawals as regular income. On the other hand, with a Roth IRA, you have an after-tax account. This means that you get paid, you pay taxes, and then you put money into your Roth IRA. That money then has the opportunity to grow tax-free as you invest it. And when you withdraw money from your Roth IRA, you do not get taxed on it because you already pay taxes up front. So the other major difference between a 401k and a Roth IRA is that within a 401k, you typically only have the option to invest in mutual funds, index funds, and target date funds. Whereas with a Roth IRA, you typically have a broader range of assets that you can invest in, like individual stocks as well. Now, the main consideration that you want to take into account when trying to decide between a 401k and a Roth IRA is, what is my income outlook? So, if I think that I'm at the peak of my earning potential today and I'll be making less money in retirement, that means that I want to delay my tax burden to when I'm in a lower tax bracket in retirement, which means that I want to go ahead and put pre-tax dollars into a 401k and then withdraw that money when I'm in a lower tax bracket. Now, on the contrary, if I believe that I will be at the peak of my earning potential in retirement because maybe I built a business or I now have a real estate portfolio, that means that I want to go ahead and front load the tax burden and pay taxes now, which means I'm going to put after tax dollars in a Roth IRA so that I can withdraw money from that account tax free when I'm in a higher tax bracket. The other consideration that people often throw out there is what the federal income tax rates are going to look like. I don't really worry about this one too much because those do fluctuate over time and it is tied to politics, so there's really no telling what that's going to be. And then the last call out that I'll make here is that you can have both accounts. So if you've maxed out a 401k, you might want to explore getting a Roth IRA or vice versa. The fourth mistake that you want to avoid making when it comes to saving for retirement is not meeting your employer match. So when you set up your 401k or Roth IRA, some employers offer to match the amount of money that you put into your retirement account up to a certain percentage of your income or your salary. So let's just put some numbers around this to give you an example. Let's say that you get paid $5,000 every pay cycle, and your employer is willing to match up to 5%, which is $250. That means that every time you put $250 into your retirement account out of your paycheck, your employer will also put in $250. Now, if you put in less than $250 or 5%, your employer will only match what you put in. And if you put over $250 or 5%, your employer is only going to put in that 5%. But this is essentially free money that your employer is offering you. And that's why it astounds me as I was reading a Society for Human Resources Management article that they estimated that $24 billion gets left on the table in the form of employer match contributions every year because employees are failing to meet the employer match. Don't be part of that statistic. Now, the other thing that you want to consider when it comes to employer matches is if your employer has a vesting schedule. And so a vesting schedule simply dictates when you get full ownership of the contributions that they give you. And there are two types of vesting schedules. The first is a graded vesting schedule, which means that, for example, if your employer gives you $250 in a match contribution, you get 20% of that $250 after year one. You get 40% ownership of that $250 after year two, and so on and so forth until you eventually attain 100% ownership of that $250. Now, the second type of vesting schedule is a cliff vesting schedule. And this means that if your employer gives you a contribution match of $250, you don't own any percent of that $250 until, let's just say, year five, and then you achieve 100% ownership. So it's not gradating up. And so the call out here is that you want to make sure that you are cognizant of how much of the employer contribution you actually own if you decide to separate from your company before that vesting schedule is up. Now, the fifth mistake that you want to avoid when it comes to saving for retirement is withdrawing money from your retirement account early. And so, as I mentioned earlier, whether you are looking at a 401k or Roth IRA, you typically can only start withdrawing money at the age of 59 and a half years old without penalty. Now, with a Roth IRA, there is an additional stipulation that states that contributions to the Roth IRA have to be held within the account for 5 years before you can withdraw it penalty free. And so, what do penalties look like? Well, with a 401k, you have put pre-tax dollars into the account. So if you withdraw money before the age of 59 and a half, that means that you will pay income tax on that withdrawal as well as a 10% penalty. With a Roth IRA, because you've already paid taxes going into the account, if you withdraw money before the age of 59 and a half, you are simply going to pay that 10% penalty fee. And this is an average penalty fee. It's of course going to vary depending on the type of account that you have. Now, the additional stipulation, again, with the Roth IRA is that if you withdraw money that hasn't been in the account for 5 years, you will also incur that 10% average penalty. And so that means if you've invested money at the age of 58, for example, and you withdraw it before 63, which is that 5 year period, but after the age of 59 and a half, you're still going to incur that 10% penalty. And so those are the 5 key mistakes that you want to avoid when it comes to saving for retirement. Number 1, make sure that you're not just putting money in your retirement account, make sure that you're actually investing it as well. Number 2, make sure that you are managing your investment elections and that you are aware of your options. Number 3, make sure that you know the difference between a 401k and a Roth IRA so that you can make an informed decision based on your income outlook. Number 4, make sure that you are meeting your employer match and not leaving free money on the table, as well as making sure that you are aware of your employer's vesting schedule if they have one. And then number 5, make sure that you do not withdraw funds early from your retirement accounts. Now, I do want to leave you with this. I mean, listen, life is a game of trade-offs. The call out here is sacrifice a little today so you can live a bigger, better life in the future. And the beautiful thing is it's never too late to start. You have time to put yourself on the right track as long as you remain intentional. So if you found value in this video, make sure you hit the like button, make sure you subscribe to the channel, and also hit that notification bell so that you can be apprised as we drop content weekly. And once again, if you don't believe that you can do better, I'm here to make sure you know better. Upskill professionals, helping you forge a path upward.